In this presentation, we will take a look at post-tax deductions within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We are in our payroll problem test file. You can follow along in your own business file or take a look at the free test drive file provided by Intuit, provided by QuickBooks. We're going to go down to the Workers tab on the left side. As we scroll down the Workers tab, we see that we have our 3 employees. We are going to consider the post-tax deductions related to these employees. Let's start off by looking at a check first. So we're going to look at a payroll check processed. As we process the payroll up top, we're going to go to the Accounting tab on the left to do so. We're going to look at the checking account and view the checking account. This is where we processed our payroll checks from. If you have a payroll checking account to process the payroll checks, you can take a look at that item. We are then going to select a payroll check. So we're going to select Anthony Moore up top and select the payroll check and edit the payroll item. That'll give us the detail. We're going to jump then to the payroll input screen for this check. We've got the gross pay up top, and then we're looking at the employee taxes. The employee taxes, of course, aren't what we're considering for post-tax deductions. These will be the actual tax that was deducted. Our goal when we're considering the post-tax deductions, what we're considering is what are those things that are going to be deducted from the pay that have no effect on these items. In other words, the things that are going to be taken out of the pay and not reduce the amount of federal taxes, Social Security, and Medicare, or increase them, but typically we're thinking about things that would decrease them. So we may think most of the deductions we have, you might think, well, why do we have a deduction? Normally we have a deduction because it's going to have an effect on these taxes. For example, the biggest deduction there is a 401k plan. Typically, that's one of the biggest benefits we can have, even if there's no matching or some type of retirement plan. Even if there's no matching, we want to put money into that retirement plan, not because it's labeled retirement plan. That's not why we do it. It's going to be restricted money that we can't get to as easily. It's going to have restrictions. We don't want to put the money in there unless we get something. What do we get? Typically, we get the federal income tax to be reduced. That's why we put the money into the retirement plan, even if there's no matching for it. So in that case, it would be something that would be affecting this plan. Many of the deductions we think about, that's the reason for them. The reason we're having the deductions, the benefits that would be provided, are because they're going to be affecting the taxes. We're now considering those types of deductions that may not be affecting the taxes. And the question is, well, why would that happen? Why would we have a deduction? Why would we have something come out of our pay, not get the money for it, unless it's going into something that's going to help us reduce our taxes? And it might just be out of convenience. It might be out of something that we can get a cheaper kind of group rate. So for example, if we were to take something out like a health insurance, then it might be the fact that if we do the company health insurance, we get a better group rate, even if we don't get any kind of benefit of reduction of our taxes to put the money into the health insurance. So we may or may not, in that case, depending on the type of health insurance that we're putting into, get the tax benefit, but we still might get a benefit. Or it might just simply be the convenience of having it taken out of our paycheck. If we're going to take it out of our paycheck and say, just pay it for me, and if you can do that service for me and pay this monthly bill, and I don't even have to see it, and that would be great, then it might just be convenient to do that. And in some cases, we might have required deductions like union dues or like something like a garnishment that has to be taken out. They got to take it out, and it's not going to help out our taxes, the garnishment, right? They're going to take out the garnishment just as a requirement to make sure that we pay whatever the court mandated thing it was that we're going to have to pay. So those types of deductions these are the deductions that are going to be down here. There's no easy way for us to see that. I mean, there's nothing here on the deductions that basically says, hey, this is affecting taxes, like this 401k is being deducted. There's nothing telling me here that this is not a post-tax deduction. This is a deduction that is affecting the 401k. We just kind of have to know that. That's kind of the tricky thing about these deductions, and that's the thing that really throws things off in a way. So the 401k is something that's going to affect the taxes. The dental provider and the eye, it really depends on how we set up those items in the list, what we qualify for. We have to determine, first of all, does it qualify as something that we could reduce taxes for, and then enter it into the system as either something that will reduce taxes or as a post deduction item. So these are the items down here. These deductions from the paycheck are the ones we're considering as possibly being post-tax deductions. But when looking at the detail, the paycheck stub, we can tell that they're being deducted from gross pay, but we can't tell typically just from looking at this item whether it is or is not a post-tax deduction, whether it is or is not reducing this amount. We have to know from basically the settings when we set up these items. So let's go back and now take a look at those settings and consider them. So if we close this back out, we're then going to go back to our Workers tab. And let's then go to, we were looking at Anthony, so let's look at Anthony Moore. And let's take a look at the settings. So we'll go to the Pay settings up top. And then if we scroll down, here are the deduction items. So we had a 401k plan, we had the dental provider, and we had the dental and the eye. So let's take a look at these two items. The dental, if we select the dental, and we look at the options for the dental, we'll note that down here it says, is it taxable or pre-tax? And this one says it's going to be a taxable insurance item. This is just the logistics of it, that we set it up in the system that way. We set it up as a taxable item, which means it is a post-tax deduction. It's not something that, in other words, is going to reduce the taxes. And that's just, we would have to see if it qualifies for something that reduces taxes. If not, it may still be a benefit because we might get some kind of group rate on the dental plan, and that would be great. And we would basically take it out of the employee pay, but it wouldn't be something in that case that would be reducing their taxes. So those would be kind of the pros and cons there. If I close this one back out, and we then take a look at the vision, so let's edit this again and compare that to the vision. If we go down to the eye, that's another type of insurance we had, and this one was pre-tax, which means that it is not a post-tax deduction item. It's something that is affecting the taxes. Both of these items, in other words, are coming out of the gross pay. So they're all being paid, they're both being paid by the employee, but one is deducting the taxes too. It's reducing the amount of taxes, at least the federal income tax, possibly Social Security and Medicare. The other is not. It's just coming out of gross pay, not reducing any taxes. So that's kind of the difference between those two. And again, that's kind of the tricky area for us to understand. Those differences between whether it is post-tax or not is what really kind of complicates our reporting a lot of times in terms of the 941s, the W-2s, and whatnot. So if we select these items, to set that up, of course, we can add a new item here. And if we were to select a garnishment, that would definitely be a post-tax deduction item. It's not something that's going to lower our taxes. It's going to come out of our paycheck or the employee paycheck, and it's not going to reduce the taxes. And then we could select an item here. We could have things like a health savings account. If we qualify for the health savings account, it could be something that reduces the taxes. Depends if it qualifies. The insurance, of course, as we've seen a few examples of the insurance, like the vision and the dental, we could have medical insurance. If it qualifies, it could be something that would lower the taxes, and that would be great. If not, then it would be something that we could still possibly benefit from by having a group insurance, and we'd have to see what we qualify for and then select the proper format in here. We'll see different formats as we work through our comprehensive problem. And then if we were choosing some other kind of deduction, we can go through a retirement plan. Typically a retirement plan, of course, the employee portion is going to be something that will typically reduce the taxes. The health savings plan, hopefully it reduces the taxes. That's one of the major purposes of doing it. The health insurance, again, hopefully we can set it up so it'll reduce taxes. That's one of the major purposes. Other deductions, we can set up just about any type of other deduction that the employee wants because it's their money. So any other deduction, and it could be something like union dues would typically be a post-tax deduction that we would take out of the check and pay directly. But it could be anything that they want us to pay. We could pay their normal monthly expenses if they would want to, and it wouldn't be something that we would be reducing their payment by, but it might be a benefit to them because then we can make the payment directly out of the check and give them the benefit of that. If that would be something that would be beneficial for them, for us to just pay whatever monthly pay would be necessary, we can do that, and we could set up some other deduction for the employee in those cases. We will take a look at these options when we process our comprehensive problem, and we'll do this in a very scientific way. We'll compare and contrast these options and look at the differences from them, what the differences will be in setting them up, what the differences will be in the paycheck stubs, what the differences will be as they report the financial statements, and what the differences are on the reports, including the 941s and W-2s, W-3s. For more accounting information and accounting courses, visit our website at accountinginstruction.info.